Why did early derivatives markets cause crises? Imagine a world where financial contracts could change the course of entire economies. That's what early derivatives markets did, but not always for the better. These markets started thousands of years ago, with ancient Mesopotamian farmers and traders locking in prices for crops and goods. It was a way to manage risk in uncertain times. Fast forward to the 19th century, and the first organized derivatives markets appeared, like the Chicago Board of Trade. They created standardized futures contracts for commodities such as grain, which helped farmers and merchants protect themselves from sudden price swings. But these innovations also brought new problems. Traders began to use derivatives not just to hedge, but to gamble on price movements. Instead of protecting themselves from risk, some traders aimed to make quick profits. This turned the markets into places of speculation, where prices could detach from real economic values. An example from history is the Dutch Tulip Mania in the 1630s, where people bought and sold tulip bulb contracts just to make money, ignoring the actual value of the bulbs. When the bubble burst, many lost everything, and the economy suffered. Another issue was that early derivatives markets lacked proper rules and oversight. Without clear regulations, traders could take excessive risks or even commit fraud. The contracts were often complicated, and it was hard for regulators or traders to understand the true level of risk involved. This lack of transparency meant that when confidence dropped, markets could suddenly collapse. The interconnected nature of derivatives also played a role. Because these contracts involved multiple parties and layers of agreements, if one trader defaulted, it could cause a chain reaction. This systemic risk meant that a failure in one part of the market could spread quickly, causing wider financial instability. As derivatives expanded beyond commodities to include financial instruments like interest rates and currencies, their complexity grew. While these new tools offered better ways to manage risk, they also created opportunities for risky speculation. Without strong safeguards, these activities could lead to market crashes and financial crises. In summary, early derivatives markets caused crises because they introduced new risks and opportunities for speculation that were not well understood or controlled. Lack of regulation, transparency issues, and the interconnectedness of contracts made markets vulnerable to sudden collapses. Recognizing these issues from history helps us see why modern markets focus on better rules and oversight to prevent similar problems.